Since we last spoke to you in October 2013, has there been any changes in your profile or the types of funds that you manage?
I still manage the same two areas of funds. First of all, I manage the TD Target Return Funds, and for that, that's a global asset allocation product. And it's essentially a flexible go anywhere fund, and we're trying to achieve two targets, T-bills plus 3% or T-bills plus 5%. And in today's T-bill environment, those are 4 and 6% target rates. So that's one area. The other area that I manage are Canadian value equities. Now we're able to go slightly outside of Canada as well in order to get our equity exposure, but most of it is in Canada, where we're looking at equity opportunities all across the market cap spectrum.
The year 2013 is behind us. It's fair to say that by all accounts it was a very good year for equity investors, as stock markets, especially in the US, soared to new heights. What factors do you think played a key role in such a meteoric rise?
I think there were a few factors that actually played a role. First of all, if you look at valuations of the equity market, they were very attractive going into 2013. So if you compare the earnings yields, which is the inverse of the price-earnings ratio, and you compare that against interest rates, that differential was quite wide, and that caused some of the outperformance of the equity market. Secondly, there was very accommodative central bank policy. So in order to spur economic growth, central banks kept interest rates quite low. And thirdly, and I think this is also very important, companies had very strong balance sheets and were generating large amounts of free cash flow. So they were able, because of the strength of the balance sheet, to use the free cash flow either to increase dividends or do stock buyback programs. So I would say those are three of the key factors. So strong balance sheet that allowed corporations to do buybacks and dividends, accommodative central bank policy, as well as attractive valuations going into 2013.
So where do we go from here? What is your outlook for 2014 on the overall economy in the US and Canada in general, and the stock markets in particular?
If you look at 2014, many of the same conditions that existed in 2013 still exist today. So we're very constructive on the market for 2014. You're looking at global GDP growth in the 3 to 4% range. And if you start looking at different countries, if you look at the US market, they're getting reasonable GDP growth. They're also having a housing market that's come back. They've got employment growth. So the US picture is quite reasonable. If you look at Canada, it's a little bit different. The emerging markets drove our commodity sector. The emerging market growth has come off quite a bit. So that's a bit of an issue that we need to overcome. The Canadian housing market has slowed, another issue that we have to overcome. So I would say that's on the less good news side. However, for some sectors of the economy, the falling Canadian dollar is actually a positive, in the sense that if you're in the manufacturing sector or other export-driven sectors, the falling Canadian dollar, at least in the recent past, is a benefit.
The housing sector continues to defy gravity here in Canada. The last time you spoke to us, you didn't seem to think that the US-style crash is likely here. Do you continue to believe that? What happens when interest rates really go up?
So when you look at the Canadian housing market, I think it's the structure of the Canadian housing market that would make a US-style outcome unlikely. And I think just to step back and just look at the structure of the Canadian housing market and the differences between Canada and the US. First of all, when a Canadian bank goes and originates a mortgage, they do their risk management, they do the underwriting, and they actually keep the mortgages for the most part on their own balance sheets. So they retain the risk over time if they did something wrong in the underwriting process. In the US, it's a little different. The US financial institution can underwrite the mortgage, give the mortgage to a homeowner, but they may or may not keep the mortgage on their balance sheet. Sometimes they sell it into the marketplace, so they don't retain the risks over time. So that's a big difference in risk management across the two countries' financial systems. In addition, if you look at Canada, in Canada, Canadian banks use mortgage insurance against some part of their portfolio through the CMHC. So the combination of just a different market structure by keeping risks on the balance sheet and mortgage insurance, that's different versus the US. But I think if you look at some of the concerns that investors have around the Canadian housing market, certainly one of them would be if unemployment rates rose, that would be an issue across all the credit spectrum. So whether that's credit cards or mortgages, that's an issue. And certainly the last question that you asked about rising interest rates, I think Canadians have actually taken that into account. Interest rates rose last year, and Canadians tend to be going more towards fixed rate and fixed term mortgages as opposed to variable rate mortgages. So if there's an issue in their lives, for example, job loss, they know that their payment stream on their mortgage is going to stay consistent over a number of years.
What lessons can investors learn from the past year, and where should they focus in 2014?
I think when you think about lessons that an investor can learn, and certainly there's lots, but one of them is to be patient and wait for opportunities. And I think we've learned that lesson numerous times over the last number of years. Certainly if you go back to 2007, 2008, 2009, there were very, very attractive opportunities to invest in equities. But even if you go back to the last 12 or 18 months, if you had a view that the U.S. domestic economy was going to improve or the U.S. consumer was on the mend, and you invested in that particular area of the market, that's really paid off for investors who did that. But when you look at us as value investors, what we're really after when we look at an investment, and we have to be patient because sometimes the opportunities just aren't there, sometimes we have to wait for them, but what we're really looking for as investors are quality franchises with solid management teams, strong balance sheets, high returns on capital, growing free cash flow, and we want that entire package at an attractive valuation. So when we're looking for those kind of characteristics, even we have to be patient in order to be able to execute.
Do you think the economies and stock markets in the developed world will continue to outperform the ones in emerging markets in coming years?
Certainly when you look over the recent past, developed markets have outperformed emerging markets by a substantial margin. And I think when you look at emerging markets, each of the different emerging market countries, certainly the larger ones, have different issues that they need to overcome, certainly domestically. And let's take China as an example. China has been able to grow their economy at above average rates, and that's because of the fact that they built out their infrastructure. So over the last decade plus, their economic growth was as a result of the infrastructure boom. They're moving more to a consumer-driven economy. So there's a transition phase that needs to take place. So what you want in these transition phases is a period and a backdrop of solid global economic growth. And if you look at global GDP forecasts for 2014, they're in the 3 to 4% range. So that's very supportive for emerging markets.
Are there pockets of undervaluation and opportunities still available that appear attractive to you?
Certainly the market always has areas of opportunity. Sometimes you just have to look a little harder or look in different places. What we find attractive right now are in the Canadian financial space with like banks and insurance companies. If you look at the average Canadian bank, it sells at a price-earnings ratio of about 11 times with a dividend yield on average of about 4%, which can grow over time. So that's an interesting area. If interest rates rise, insurance companies should do well. So that's another interesting area that we're looking at. In addition to that, an area that's been ignored is the Canadian large cap energy space. And I think the reason that people aren't as interested in it is because of the issues around things like Keystone XL or the fact that you're getting growing production out of the U.S. shale oil area. But I think Canadian large cap energy is another area that we find very attractive.
The last time you mentioned Suncor and Bank of Nova Scotia as your preferred picks. BNS has done quite well since then. Do you continue to like these two names, and why?
Certainly we like those two names, if just focusing on energy for a moment. If you look at Suncor, what they're going to be able to do is actually grow production and grow their dividend while at the same time being free cash flow positive. And that's something very, very few oil and gas producers anywhere in the world can actually do. And when you look at that profile and you say, okay, what am I paying for this? What you're getting is a company that you can get at a discount in terms of a cash flow multiple relative to its peer group at a modest discount to net asset value. And the fact is you're actually getting paid to wait to get a dividend yield of around 2%. So that's the energy side. If you move towards financials in the Bank of Nova Scotia, it's another interesting company in the sense that they've made some acquisitions. They made the acquisition of ING Direct here in Canada. That should reduce their funding costs. The other thing is recently they've suffered as a result of their Latin American operations. They've had higher credit costs. But when you look at the Canadian retail lending landscape, it's very, very competitive. And if you can lend outside of Canada, that's positive. And I think over time, even though they've had a tougher time in the recent past in Latin America, those credit costs should subside and that should drive profitability in the future. Once again, what am I getting this package at? At Bank of Nova Scotia, I'm getting a company at less than 12 times 2014 earnings with a dividend yield of slightly under 4%.
Are there any other names from your top 10 holdings that you can share with our viewers?
Sure. When we look at our names, we look at it in the context of the entire portfolio. So another name that's in our top 10 on the Canadian energy side is Canadian Natural Resources. And it's a little different than Suncor in the sense that it's more volatile because it doesn't have the refinery operations that help to offset oil price volatility. But what we find attractive is the growing free cash flow profile of the company. And you've seen management's belief in that growing free cash flow profile because they increased the dividend by 60%. So what Canadian Natural Resources has done is they spent a lot of money in terms of capital expenditures in order to get their oil sands production on stream. And you're going to see the benefits of that over the next few years. So if you look at what the cash flow could be a few years out from today and you assume current commodity prices, they could have over $4 billion in free cash flow. You have to assume the current commodity price deck in order to see that, and that's still a few years away. But when you ask yourself, okay, how much once again am I paying for this? You also get Canadian Natural Resources at a cash flow discount relative to its global peer group. And once again, you get a dividend yield of just over 2% while you wait.
Thank you for taking the time for the interview today, Anish.
Thank you for having me.
Subscribe to our daily newsletter and be the first to get expert insights and advice from our roster of industry specialists. SmallCapPower.com, investment ideas and research.